Every headline about the global economy this year has been about war, tariffs, and inflation in rich countries. But underneath that noise, one number keeps repeating in IMF and World Bank reports: emerging markets are still growing 2 to 3 times faster than advanced economies. India's economy is projected to grow 6.4% this year. China's economy, even while slowing, is still growing faster than any G7 country. By 2030, the World Bank's own chief economist says the coming decade could unlock the kind of transformative growth we haven't seen since the 2000s. This video is about what's actually driving that, and where the projections could still go wrong. In April 2026, the IMF was preparing to upgrade its global growth forecast. Then war broke out in the Middle East. Energy and food prices spiked, and global growth projections were cut to 3.1% for 2026, with inflation revised up to 4.4%. The World Bank's numbers are more sobering still, global growth slowing to just 2.5% in 2026, with emerging and developing economies facing their weakest per capita income growth since the pandemic. The damage isn't even. The Middle East and North Africa region absorbed the sharpest hit, a nearly 3 percentage point growth downgrade for 2026 alone. Meanwhile, South Asia remained the fastest growing region in the world, largely insulated by its lower dependence on energy imports. Strip away the war shock, and the underlying growth gap between rich and developing economies hasn't disappeared, it's just been temporarily compressed. The IMF projects emerging and developing economies growing 3.8% in 2026, recovering to 4.5% in 2027, while advanced economies stay closer to 1.5 to 1.8%. That gap is the mathematical core of the convergence story, economies starting from a lower base, with more room to grow through catch-up productivity gains, urbanization, and a younger workforce. Compare that to advanced economies, many of which are dealing with aging populations and workforces that are shrinking, not expanding. Lumping emerging markets together as one story is misleading. The divergence between individual countries has rarely been this stark. India remains the fastest growing major economy in the world, at 6.4% for 2026, driven by strong private consumption and a booming services sector. China, by contrast, is projected to slow to 4.6%, weighed down by higher oil prices, structural headwinds, and prolonged economic uncertainty. Southeast Asian economies like Vietnam and Indonesia sit in a different bracket entirely, benefiting from supply chain diversification away from China, without carrying China's structural baggage. And commodity exporters like Russia are being kept afloat almost entirely by higher energy prices, not by underlying economic strength. The World Bank's own framing is blunt: without structural change, the 2020s risk becoming a lost decade for much of the developing world. But their 2030s projection rests on 3 specific forces converging: artificial intelligence, energy transformation, and deeper regional economic integration. On AI specifically, the World Bank's illustrative scenarios show a wide range of outcomes. Under optimistic productivity assumptions, growth in the 2030s could exceed the average seen in the 2000s. Regional trade integration is the least flashy of the 3 drivers, but arguably the most concrete. Deeper regional supply chains reduce the developing world's dependence on any single advanced economy's demand. None of these 3 forces are guaranteed. They're framed explicitly as potential, not as a locked-in forecast. Investor behavior gives us a real-time read that forecasts alone can't. Despite the Middle East shock, the IMF notes that portfolio flows to emerging markets have stabilized after an initial sharp pullback, and investor appetite for hard currency emerging market debt remains robust. Several high-yield emerging and frontier economies have successfully issued sovereign bonds even through the volatility, a sign that investors are pricing in the medium-term growth story, not just the current shock. That's a meaningfully different picture than previous EM crises, where capital typically fled at the first sign of geopolitical stress. None of this is a guaranteed outcome, and the same reports driving this optimism are equally blunt about the risks. Rising debt is pushing up borrowing costs for developing economies, especially the most indebted ones, and the World Bank explicitly flags this as a threat to the whole growth story. Nearly half of all developing economies have failed, since 2019, to narrow the income gap with the world's wealthiest countries at all. Convergence is not automatic. A longer or broader Middle East conflict, renewed trade tensions, or a disappointing AI productivity payoff could each independently knock this trajectory off course. Weather-related shocks and a resurgent Ebola outbreak are also flagged as new downside risks specifically for the lowest-income countries. So is this the rise of emerging markets, or another decade of disappointment? Based on the data, the honest answer is, both, depending on the country and the year. 2026 is a genuine setback, driven by a war nobody forecast in January. But the structural growth differential between emerging and advanced economies hasn't gone away, it's just been temporarily buried under a commodity shock. Whether the 2030s actually deliver on that potential depends on three things that are still, genuinely, up for grabs: how AI productivity plays out, how deep regional integration actually goes, and whether debt burdens stay manageable. The projections aren't a promise. They're a range of plausible futures, and right now, the data says that range is still wide open.